The dollar is at 100. The 10-year yield is at 4.42%, and silver is sitting at $69.59 and refusing to go down. If you have followed these markets for any length of time, you know that combination should not exist. A strong dollar and elevated yields have historically pressured precious metals, and yet here we are. So either the market is wrong or something has changed. I have been in these markets for 15 years, and I want to show you exactly which one it is, because the answer matters for how you position yourself right now. Last week I told you to watch the Shanghai silver premium, specifically whether it held above $2 per ounce against Western spot prices. I said if that premium sustained, it would not be noise, it would be a directional signal about where physical silver is actually being valued. Here is what happened. The premium not only held, it widened. As of this week, it is around $2.26 per ounce over Western spot. That call is on record. It hit. And what it is telling us now, combined with a 100 DXY and silver holding firm, is the core of this entire video. My name is John FX Insider. I spent 15 years inside currency and commodity markets before I ever picked up a camera. Everything I share comes from that experience and is backed by publicly available data. I started making these videos because I watched retail investors navigate markets using outdated frameworks where a rising dollar automatically meant falling silver. That relationship still exists, but it has changed, and today I will show you exactly how, why, and what it means for your positioning if this kind of calm data first breakdown is what you have been looking for. Hit the like button and subscribe, because what we are building here is a framework most retail investors simply do not have access to. Here is what we are covering. First, the historical relationship between the dollar, yields, and silver, and what has changed. Second, the Shanghai arbitrage mechanism and why this premium matters. And third, the 3 lanes framework for this week, and the one signal I am watching to confirm whether this shift is real or temporary. Quick question. When you see the dollar strengthen and silver hold its price, is that a buy signal or a warning? Drop your answer below. Let me start with the historical relationship. For decades, the correlation between the US dollar index and silver has been strongly negative. Dollar up, silver down. The reason is simple: silver is priced in dollars globally. When the dollar strengthens, silver becomes more expensive for non-dollar buyers, demand softens, and price falls. Add rising yields to that, and the pressure increases. At 4.42% on the 10-year, Treasuries become a real competitor to silver. Investors are paid to hold them. That creates a genuine pull away from non-yielding assets like silver. So when silver holds near $69.59 with DXY at 100 and yields elevated, the market is breaking a long-standing relationship. And when a relationship that consistent starts to shift, it is rarely random. There is usually a structural reason. The Shanghai silver premium is around $2.26 per ounce over Western spot. Now this matters. Premiums can reflect taxes, logistics, or structural differences. That caveat is real. But the key difference is persistence. A temporary premium spikes and fades. A structural premium sustains and widens. That is what we are seeing. Now, when I compare this with declining COMEX open interest down about 1.39% this week, the picture sharpens. The Western paper market is thinning. The Eastern physical market is tightening. Think of it like 2 connected systems. Demand in the East is pulling metal faster than the West is supplying it. That imbalance shows up as a premium in one market and resilience in another. That is what decoupling looks like. Not a sudden break, but a gradual shift in pricing pressure. Now let's look at what is driving that demand. The Silver Institute has documented a consistent rise in industrial silver demand. The fastest growing areas are solar and electronics, especially those tied to AI infrastructure. Silver is the most conductive metal. In high-performance electronics, it is difficult to replace. Data centers, semiconductors, and energy systems all rely on it. Here is the important point. Industrial demand operates on long timelines. A manufacturer does not cancel supply contracts because the dollar moves. That creates stability in demand, and this leads to the key structural shift. Silver demand is no longer dominated by macro-driven investment flows. Industrial demand has grown as a share of total consumption. That changes how price reacts to macro pressure. It does not eliminate macro influence, but it creates a floor. When the dollar strengthens, macro demand weakens, but industrial demand absorbs part of that pressure. That is why silver is holding despite conditions that historically would push it lower. Think of it as a floor and a ceiling. Industrial demand limits the downside. Macro conditions still influence the upside. Now layer on top of that the structural factors we discussed last week: inventory pressure and positioning, and you get a market that looks more like a compressed spring sitting on a solid floor. That is the setup we are in right now. Now let me break this down using the 3 lanes framework. Lane 1, the paper market. COMEX open interest is down slightly this week. I read that as caution, not bearishness. Traders are stepping back, not aggressively shorting. A thinner paper market heading into delivery periods can increase volatility because there is less liquidity to absorb demand. Lane to the physical market. The Shanghai premium is the headline, but the broader trend is a tightening physical market. Metal is flowing east, and that flow is not quickly reversible. Refining and transport take time. This creates sustained pressure. Lane 2 is tightening. Lane 3 macro. The dollar at 100 and yields at 4.42% are real headwinds. I am not dismissing them. What I am saying is that right now, physical demand and industrial consumption are offsetting that pressure. The key question is trajectory. If the dollar strengthens further and yields rise, the balance could shift. Right now, it is holding. When all three lanes interact like this, paper thinning, physical tightening, macro pressure present, the resolution is rarely slow. It tends to be a sharp move once a trigger appears, which brings me to the one thing I am watching, the DXY at 100. If the dollar holds above 100 and silver holds above $69, the decoupling is confirmed in real time. That is strong evidence of a structural shift. If the dollar holds and silver breaks below $68, the macro pressure is winning and the floor is not holding. If the dollar fails and drops below 100, then both macro and structural forces align, and that historically leads to strong upward moves. This is my one call for the week. I will come back next video and show you exactly what happened. Now let me give you both scenarios clearly. Bull case, the dollar weakens or fails to hold above 100. Industrial demand and physical premiums amplify the move. In that case, silver moving toward 72.75 becomes realistic. Cautious case, the dollar strengthens further and yields rise. Macro pressure outweighs structural support, leading to a pullback toward 66.68. Both outcomes are possible. Your job is not to predict, it is to observe. Before we close, disclaimer. This is educational content based on public data. It is not financial advice. If you found value in this, hit the like button. It helps more than you think. 2 questions before you go. Are you treating silver as a macro hedge, an industrial play, or both? And if the dollar drops below 100, what is your first move? Drop your answers below. I read every comment. Subscribe, because next week I will break down the dollar-silver relationship using real data so you can read it yourself. This is Currency Insider. Know the market, protect your currency.